Hi, Eoin McGee here, financial planner. I'm here to take your questions on the Newstalk Facebook Live. We didn't do a Q&A live on air today, so we have lots of space today to get your questions in. We have a few questions we didn't get to last week. We're going to go through them, but get your questions in and hopefully we'll be able to answer them. So, first question coming up.
Okay, our first question. How do we go about finding a financial advisor? We have a modest amount to save/invest for our young family's future and would like advice about it and mortgage, pensions, etc. How do we find a good financial advisor? Thanks, Rebecca.
So Rebecca wants to know, how do you find a financial advisor? There's a couple of ways. The first place you could start is you could go into the central bank website and they have a list of all the financial advisors in the country. There are 2,625 registered advisors on that website, but there's only about 1,600 of them are kind of financial advisors. Some of the other ones that are registered are people like that sell car finance in a car garage or whatever. But that's the first place to start, is to get a registered advisor, someone who's regulated by the central bank. But also you need to talk to people. Ask your pals, who did you go to? Because it's the best way of getting a referral is to get referred into somebody because somebody else has found that the service they got was good. In a complete plug for me, the other thing you could do is you could look at enough.ie. It's a company I'm involved in, and that's a group of advisors up there. And enough.ie does actually have lots of different advisors up there. They're all independent, they're all regulated, and you could start there either. But honestly, best place to start is by asking your pals, who have you gone to or where do you get them? Because if their experience is good, it suggests that your experience is going to be good too.
Our next question comes from Owen. I am 24 years old, saving roughly between €800 and €1,000 a month for a house. I currently have 13,000 saved. I have a pension in place thanks to work and owe 8,000 on my car. Am I better off to continue transferring my savings each month into my credit union account, or are there other accounts I can transfer to try and beat inflation and get a better return on my savings? I'm aiming to build by the age of 30.
Aiming to build by the age of 30, and you're 24 now, is that what you said? So you're 24 years of age now. So that means you've got 6 years before you're going to be able to, or before you want to actually build. Now you can move away from bank accounts. So we always say it on the Facebook Live, if you've got less than 5 years, you need to use bank accounts and deposit accounts and credit unions and on posts, and you just need to suck it up that the interest rate you're going to get on it is crap and you're going to lose against inflation over the long period of time. But when it's more than 5 years, you can actually invest in stocks and shares and bonds and those type of things. So you can go in, just be careful on charges. You can go into a bank or you can go to a life company like the Irish Lifes, the New Irelands, the Zurichs, the Standard Lifes, all the different companies that are out there, and they will actually sell you a long-term investment plan. And these are suitable for 5 years plus. You should get better returns. The reason why we talk about 5 years plus is because with these investments, there's a 25% chance, so 1 in every 4 years, you're going to lose money on it. And it is going to be down on average 1 every 4 years. So if you were just saving for 1 year, there's a 25% chance that you would lose money over 1 year. Go to 3 years and it's about an 85% chance that you will be positive, or a 15% chance you're going to lose money. When you get to 5 years or 5 years or more, there's only a 2% chance based on history that you would lose money over a 5-year period. So there's a 98% chance you're going to make money over a 5-year period. And when you start going out beyond that, it gets to a 100% chance of making money if you set it up right and you do what we call invest and forget. That is, you set it up, you put the money in on a month-to-month basis, and then you don't react when the markets fall apart, which they do on average 1 every 4 years, and on average we have a major decline every 3 to 5 years. And what I mean by a major decline is you could be looking at on average about 31% drop in what's in the value. So if you had 10 grand in it, you'd look at the end of that year and there might be €7,000 in it. That's what happens. We know what's going to happen. We expect it. We don't react when it does. We invest and we forget. So 5 years plus, fair play to you, by the way, €800 to €1,000, 24 years of age, and you've got your pension box ticked as well, and you've got 13 grand in savings, and you've got a 6-year time horizon. You're going to do really well if you keep doing that. But get away from the bank account and stick it into a long-term savings plan if that's what your goal is.
So Paul just has a quick question. What was the name of the book for small business owners about why we do it?
So the book, that was a book we talked about on air. It's a book by Simon Sinek, Sinek, I think is how you spell it. And it's called Start With Why. It's a brilliant book, like really good book for a small business owner, because it really makes you think about why you do what you do. What is it that gets you out of bed in the morning? What joy do you get out of the business that you have? And it's got some great examples. If you're really lazy, he has a YouTube clip. I think it's a kind of 15 or 20 minutes long. It's worth watching that alone, and it's brilliant. It's Simon Sinek, Sinek, Start with Why. Brilliant book.
So Jim wants to save for his daughter's future education and is hoping to put €200 a month away for the next 16 to 17 years. What's the best option?
It's actually, so what's the best option for long-term savings for 16, 17 years? We're back to our 60-40 portfolio. You've got more than 5-year time horizon, you go to a 60-40 portfolio. 60-40 portfolio, by the way, is 60% in shares and 40% in bonds. And it's what we call the no-brainer portfolio. CFAs, Certified Financial Analysts worldwide, there's about 200,000 of them, I think, worldwide. They were asked there was a survey done of them, and they were asked, if you had a client who wasn't getting any advice from anyone, or if a person, not a client, obviously, they're not getting advice, but if they weren't going to get advice from anybody, what should they put their money into long term? And the CFAs worldwide came back with this no-brainer 60-40 portfolio. 60% shares, 40% bonds, 17, 18-year period. Just to run the numbers on that, by the way, if you started at zero, when your child is born at zero, and you started putting the children's allowance aside, or the child benefit aside, I think is what it's called now. If you put that aside every month, that's €140 a month. If you put it into a bank account for 18 years, you need to add about €170 a month to that to be able to pay for that child's college, according to Union of Student of Ireland figures. If you do it in a 60-40 portfolio or anything kind of a long-term proper investment vehicle, you need to add about £50 a month to it to get the child through college, to have enough in that pot to get the child through college. You're saving 200, you've got 16, 17 years to go. That should work out fine for you in terms of getting the child through college if you use the right type of account. Be careful with these 60-40 portfolios. Be careful of charges. One of the charges that I hate seeing is that when you put your money in, every time you put your €200 in, they take 5% of it. So in this case, it would be a tenner would come off your €200. That's what they call in the industry the allocation rate, and that would be a 95% allocation. You want 100% allocation after the government levy is taken into account, which is 1%. So you want to make sure that when you put in 200, that the €200 is fully invested. That's your starting point when it comes to charges, is to get 100% allocation.
So Lyndon's wondering, should I fix my mortgage for the next 7 years at 2.99, coming out of a fixed rate of 3.35? We have 15 years left on it.
So should you fix your mortgage for the next 7 years at a 2.99 rate? 2.99 isn't bad. It's a good rate. But compared to people in Europe, it's not a great rate. We're about, now at the moment, I think we're about 1.5% to 2% more expensive than it would be to have a mortgage somewhere else in Europe if you just happen to live somewhere else. Let's be really clear. In ordinary functioning markets and banking, when banks are functioning properly, fixing your mortgage and then fixing it again and then getting out of that fixed period and fixing it again for the whole term of your mortgage, you keep fixing it each time, it will cost you more money. Because fixing it is an insurance. That's what it is. You're hedging your bets. You're going to have to pay for that somewhere along the line. So staying variable, or ideally tracker, the whole way through should cost you less over the term. But that doesn't mean you shouldn't fix. Fixing gives you absolute security. What I would say is you'd need to know a little bit more about what's going on around you in terms of, is there any chance you're going to move in the next 7 years? Because you could get hit with penalties if you want to move your mortgage, or if you want to move house or anything like that. What is the mortgage a huge burden on you, or is it a small part of your take-home pay? Can you afford to go variable? Anybody who tells you that they know where interest rates are going to go in the next year is guessing or lying. Nobody can tell you for sure what's going to happen to interest rates. So do I believe that 2.99% is a good rate and it's going to serve you well over the next 12 months, 2 years, 7 years is what you're talking about? Haven't a clue. No idea. Over a longer period of time, you would suggest that interest rates can only go up, and that would mean that bank interest rates, that the ECB rate's going to go up, which would suggest that the bank interest rates are going to go up in line with that. But remember, our banks have a whole pile of fat in there. They have a whole pile of extra margin that even if the base rate goes up, they could still, I suppose they won't, or it's possible they won't, but they could still absorb that and not pass it on to the customer but that's in ordinary functioning banking markets. We don't have an ordinary functioning bank market here right now. The answer to your question, very long-winded, is if it's important to you that that repayment is going to remain the same and it's a burden, the mortgage is a massive burden, I would suggest it's not a bad idea to look at it, but you need to be careful that you're not going to move house and you're not going to want to remortgage or move that mortgage switch it from one bank to another in the next 7 years, because you could get hit with penalties. You won't necessarily absolutely get hit with penalties, but you could get hit with penalties once you're in a fixed rate.
Okay, this will be our last question. I'm putting 30,000 a year into an executive pension. I'm 43 now and 3 years in the pension. I always question, is it better to just save the money, as I'm only getting 4% of the pension once I retire?
Okay, you won't get 4% of the pension when you retire. That sounds like with the ARF rules, the approved retirement funds and approved minimum retirement funds. This is when you stop paying into pension and you retire, your money moves from a pre-retirement pension into these ARF things. And basically all they are is they're just an account. And what government says is you have to draw 4% a year out of those things, out of the ARFs. And if you don't, you'll be taxed as if you do. So you pay income tax when you take the 4%. So that's probably where the 4% comes out. But let's actually keep this a little bit more simple. You're putting €30,000 a year into this pension, and you're wondering should you put it into a bank account or savings. For you to put €30,000 a year would suggest to me that you're on a decent salary, so you're probably paying you're paying the higher rate of tax. If you were to put €30,000 into the pension, you're actually getting tax relief on that. So you're getting about €12,000. You're paying €12,000 less in tax on that 30 grand if it's all a personal contribution. But not only that, if you wanted to put €30,000 into savings, in a bank account or a credit union or whatever, you'd have to earn 60,000 roughly and pay €30,000 in tax in order to get the 30,000 into the savings. So it's the opposite to what you're doing at the moment. Right now, you're putting 30,000 in and it's costing you 18,000 to get that 30,000 in. But if you wanted to put it into a savings account, you'd have to earn 60 grand of earnings, pay 30 grand, roughly 50% in tax, to get the 30,000 euros into your savings pot. So not only that, you stick it into the savings with the bank, and when it grows, you have to pay tax on it as well, on the growth. Whereas within the pension pot, it grows tax-free. So no, the answer is not. You would be better off sticking it somewhere else. But do make sure that you've got your short-term and medium-term goals sorted out in terms of savings, because 30 grand is a nice amount of money to be putting into pension. That's it. So we're finished for today. Thanks a million for your questions. We will be back. I think we'll be back next week. I'll be certainly on air next week with Ciara and on the Lunchtime Live, and then we will be doing Facebook Live afterwards, as far as I know. Thank you very much.